What's going on, everybody? This is the blockchain backer bringing you the latest cryptocurrency news and analysis. Today, we'll be talking about the Bitcoin price chart, tying that into the stock market, because yesterday I posted over here on Twitter exactly what we talk about here on this YouTube channel, presenting the case for the bottom already being in for Bitcoin. I went through and highlighted the things that we typically talk about on here for the case on why the bottom of Bitcoin can already be in. And we're not going to spend time on this video diving into all those things. You can go watch previous videos to see that, or read that thread I have on my Twitter page. But the cold, hard reality of whether or not the bottom is in for Bitcoin is on whether or not we can get the big picture correct. In essence, this guy, the US stock market. Get this right, you get everything right. Get this wrong, you get everything wrong. There is zero question that the United States stock market is in a bubble. But the question is the bubble already in? Or has this thing yet to go extremely parabolic and we're still going to get absolutely out of control before the thing eventually pops? Now, everybody wants to be the guy who calls the top of the US stock market, regardless of if that means there's 20 years of bear heading ahead of us. Everybody wants to be the guy to call the top. I've seen it in every single pullback that we have in the stock market. There's always a group of people who are the people who are gloom and dooms. And there's some people who their entire brand is always built around, this is it, this is the one, this is the collapse. And I've seen these people for several years. Their entire brand is built around the collapse coming. But is that actually what's happening in here? Because in every pullback that I've seen, I've always seen everybody screaming or groups of people screaming, this is the one, this is the collapse. And the answer on crypto, the answer on Bitcoin, the answer on the altcoins is all going to be on whether or not we can get that right. In parabolas, if you take out that level, including the 200-week moving average, the parabola has been lost. So the question is the parabola going to get lost? We just watched the Dow Jones go into a 618 Fibonacci retracement, and it is now getting rejected from that price level. Was that it? Was that the extent of the retracement? Is it going to break down and go lower? And I think in this video, we should go back and we should look at what the anatomy of actual bubble pops looks like to see if we are mimicking the behavior of bubble pops. Because what have we had? We've had a big move down. We've had a retracement. Now, do we go on and go in for the really big plunge and that this thing has already popped? Say goodnight. Well, I will at least let you know what we're doing here does not mimic what happens when bubbles pop. So we're going to go through and look at a bunch of bubbles popping, and then you'll see how the price behavior of what is happening right here does not mimic that of what happens when bubbles do pop. Now, again, if this price level got taken out down in here for the Dow Jones, if we took out the February of 2020 highs, and if we took out the 200-week moving average, my tune would change quickly on that. However, I'm going to show you why what's happening right in here is not similar to what happens when actual bubbles pop. The first thing to notice here is the orderly fall down that has happened here in the Dow Jones Industrial Average. You could say the same thing over here for the S&P 500 and over here for the NASDAQ. And maybe thinking to yourself, how is that orderly? That has been going down very quickly, but that's not what we typically see when bubbles actually pop. This is the pop of the dot-com bubble for the NASDAQ back in 2000. I want you to pay attention to that. In a bubble pop, you initially have the actual pinprick. You have the explosion of the bubble and an initial hard fall. This is the pop of the roaring 20s bubble for the Dow Jones Industrial Average back in the 1920s. As we know, it led into the Great Depression. What do we initially see? The initial prick of the actual bubble, an immediate, sharp, hard fall. You look at the pop of the bubble of gold from the 1970s to 1980, immediate, hard fall, the prick of the bubble, retracement over. You can look at the pop of the bubble for ARK, Cathie Wood's ARK Innovation ETF. Immediate hard fall to mark the pop of the bubble. You look at Bitcoin from back in 2017 and 18, immediate sharp fall to mark the pop of the actual bubble. So when we go back and look at what the anatomy of actual bubble pops have looked like for the US stock market, and for most assets, you see that there's a parabolic rise followed by an initial pricking that happens of the actual bubble or a pop of the bubble, with an initial hard crash that comes followed by some type of a retracement. For the Dow Jones Industrial Average back during the Great Depression, immediate hard, sharp crash followed by a retracement of a little over 50%. But when the initial crash came in here for the Dow Jones Industrial Average, the initial fall was 49%. When the initial fall happened here for the NASDAQ back in the dot-com bubble, an initial immediate hard crash of 40%, which is very similar to in line with what we saw actually with Bitcoin. When the bubble burst for Bitcoin back in 2018, the initial fall was right there in line with that, 43% after the initial pop, which we see here for the Dow Jones when the Great Depression happened, and we see for the NASDAQ during the dot-com bubble. Both of these violent and quick. So looking at the Dow Jones Industrial Average, are we mimicking behavior that looks like what happens when a bubble pops? Zoom out a little bit and see it's been not quite what we're used to seeing in here. Again, we can go ahead and pull the NASDAQ up in here and look at the dot-com bubble burst. Over the course of 61 days, the price fell 40%. Here we are right now. We're at 231 days, and the Dow Jones has fallen a total of just maybe right at 20%. Did it actually hit? No, it didn't. It didn't even actually hit 20% of a crash here in the Dow Jones over 231 days, whereas we can see the initial pop of the bubble for the NASDAQ in the dot-com bubble, 61 days, negative 40%. Then let's go back and look at the Dow Jones Industrial Average from the Great Depression, negative 50%, taking a total of 70 days. So the initial pricking of the bubble taking 70 days here on the Dow Jones, taking 61 days there on the NASDAQ, both showing the literal pop happening here. But here we are, 231 days into this, down 19%. Is that mimicking the behavior of what we see with bubble pops? No, not at all. Now, all of us are guilty, just no matter what, including me. Everybody is always guilty of recency bias. We take a look back to the last time we had a crash and we say, we're matching that last crash we had. We're doing the exact same thing. Well, we obviously can't point at the C19 crash because that was a literal straight line. Obviously, we're not doing that. So everybody points back to the last one, right? The great financial crisis. And you say, hey, man, look, this thing is acting so similar to what happened. Put us over here on log scale because this is not what people are doing. They're not using it in this manner, using it in log scale, saying, hey, look, we are like nearly identical to what happened with the great financial crisis before things got really out of control. What's interesting about this, right? It would tell us a story too, right? If we did do something like that, because at the same time when that occurred, what happened? It found support on the 200 week. It got through the 200 week, found resistance at it, and then lights out, down it went. But there's a big problem with this situation happening right in here. We'll just kind of draw it out like this, take that away, turn off the 200 week, and take us off of log scale to show what would happen to the United States in that circumstance. In this circumstance, this is a bubble pop. So this is the end of the U.S. stock market. Anyone saying otherwise doesn't understand bubbles. Doesn't mean we can't bounce from here and then, work way down. But that would literally be the actual end of the U.S. stock market. So if you're calling for that, you're calling for a Great Depression in the U.S. stock market. Because in the anatomy of a bubble, for those who have been with the channel for a long time, what do we have? We have the double tap, bull flag, breakout, short squeeze, violent back test with a V bottom out of here. In a bubble anatomy, you don't just come all the way back down here a second time and then go on and reset and then keep on going up like that. That's not how bubbles work. So to compare what's happening here, to compare what's happening in the great financial crisis would be saying that we are going into the Great Depression. It would not be a situation where we just recover and off and away we go. This would be the literal end. And to say we're having the same structure of what happened in the great financial crisis after we've already printed a big giant bubble, well, we just have to take into context of where we were at that time. We were in a big, long range at that time for the Dow Jones. And believe it or not, it was similar to what happened in here, but just on a much longer time scale, right? What do you have? You have a broadening wedge happening in here, right? It just gets wider on each side, just like what we were having happening in here. As this range just continued, it got violent down here for that secondary test at the bottom side of the broadening wedge, as we had happen in the great financial crisis. That's not the circumstance of where we're at right now. We are way up in a bubble. But is it going to get euphoric and out of control? Just if you're going to draw from the great financial crisis and say that's what we're going to do, you're also saying the stock market is popped and the markets are done for 20 years. And there's a lot of people who like romanticize that and fantasize that. And I don't think they really actually want that. 20 years of incredible hardship. I don't think they really want that. I think it's more out of frustration is sticking it to the man because they may feel that they've gotten left behind while the system has been rigged and they want to see the rigged players get punished. But I don't think anybody really wants that. You can sit there and celebrate and have fun for a couple of months and say, I called it, that was great. But then you got 20 years of aftermath to deal with. Your kids are going to deal with that. Your grandkids are going to deal with that. So out of like just removing the fantasy of the whole system coming down and collapsing on itself, is the market actually behaving in a manner that the pin has pricked the bubble here compared to what we've seen before? And no. And taking from the great financial crisis and saying we're doing the same thing, it's not the same thing. This is a long upward trajectory. This is the end of a range. This is the end of a range. This is attempting to break out of the range and a failure of the break out of the range and collapsing. This is an attempt to break out of a range, failing and collapsing. This is parabolic rising. And in the anatomy of a bubble, as we saw in the NASDAQ, as we saw in the Dow Jones from the Great Depression, you have a 40 to 50% collapse that happens within 60 to 100 days, 60 to 70. I mean, we could even give it more. We could say 100. We could say 150 days. Here we are, over 200 days, 19%. That's not the behavior of a collapse. And we know that if we were doing something similar to the Great Financial Crisis, that is collapse. So what could we possibly be doing here? Why are we only down 19%? Why are we holding this level? Why are we holding the 200-week moving average? Why haven't we seen the pin prick the bubble yet if the bubble is popped? Because in a bubble anatomy, you go below here, we've seen it. Even if you want to say great financial crisis, you go below the 200, it all falls apart. You go below the February of 2020 high, you lose parabolic behavior. And it is a bubble. You can't. It's unquestionable. I'm not denying that it's a bubble and that it's eventually going to burst. It most certainly will. But if the bubble is popped, we should have gone deeper and we should have done it already. So what are we doing? Because this is not like ARK, which lost 33% in 21 days or 38% in 120 days. It's not like the NASDAQ that lost 35% in 25 days or 40% in 60 days. It's not like gold that lost 30% in 7 days or 48% in 66 days. It's definitely not like the Great Depression, which lost 50% in 70 days. It is orderly. So what is going on here? And if you exclude recency bias and just say, hey, look at the last time, it's going to do what we did last time, even though we're in a different phase, right? We were in a range in 2008 and 2009. We're in a bubble in 2022. We're not mimicking the behavior of bubble pops. So what does this mimic? And it mimics a correction. It does not mimic a 40% fall happening in 60 days. It does not mimic a 50% fall happening in 70 days. It mimics an orderly correction. And really the example I have to point to that in the anatomy of a bubble, like we've talked about with double tap, bull flag, breakout, violent back test, double tap, bull flag, breakout, violent back test, both with V bottoms pulling out of here, is even looking back at Bitcoin's anatomy of its last bubble structure in 2017. You have your run-ups happening in here, double tap, bull flag, breakout, backtest, V bottom. Then you come in here with an ABC correction. We have the Dow Jones in here moving its way up, double tap, bull flag, breakout, violent backtest, V bottom. If this is an ABC correction happening in here, looking back where this actually happened on Bitcoin as well, by taking a measurement right in here, we could say, hey, look how high this thing went before we ended up doing that. You could see where the corrections were taking place in here, how high we got, where did we go to? We came up just shy of actually hitting a 4.236 extension in here. And then what did we do? We bounced around in here, right? Dipping below the 3.618, not quite down to the 2.618, big violent ABC correction happening in there. Where are we at over here with the Dow Jones? We're in similar locations, right? Happening in the same place, above the 3.618, below the 3.618, but still violently bouncing around in here, which you could see even in there, right? Even bounced right off here, off this level at the same time. But what ended up happening to Bitcoin, right? That wasn't actually the end of the parabolic rise that was going on in there. same double taps, violent backtest V bottom, then what? A correction. And what happened after that? It went on for a real bubble. And that was Bitcoin only at 10K. And then what happened when the real top came in? Just like we've been looking at with all those bubbles. Massive big fall, negative 43% in 5 days. And boom, that marked the pop of the bubble, which then went on for a very, very long time. So has this gotten excessive at this point? And are we showing the anatomy of an actual pop? I don't think so. The story gets told if that level ever breaks right in there, but we are not acting like a bubble actually popping in here. Everybody's become a Fed expert. I get it. Everybody knows the Fed. Everybody can read them. Everybody knows what they're saying, what they're not saying, how to read the secret code of the Fed. I get it. We're all Fed experts now. But you cannot have the anatomy of a bubble like this that we've had so far to this point and then break down and go down here and the bubble still be intact. It's either popped or it's not popped. Either that low holds or it's all over. Are we acting like what it's like when it's all over, where a bubble pops, negative 40%, negative 50%, 60 days, 70 days, 100 days, 150 days, who cares? 231 days down 19%. That's not the anatomy of what a pop looks like. And the anatomy of it is much more of that of double tap, bull flag, breakout, backtest, V bottom, ABC correction, and that more up is coming. Why does that sound dumb to say right here, right? Because no one's willing to say that. You take a lot of reputational risk when you sit here and say, I think the bottom is in. I think things are going to hold and we're going to be okay at this point. Why? Because everybody's already experienced a whole lot of pain. If this thing goes down one more time, you look like a dingus. That's why you're not going to find a lot of content creators like putting their name on it right now saying the bottom is in, even if they think there's a chance for it. They're probably all long. They probably have their bags completely full. And then if the market shoots to the upside, say, hey, you know what? I'm okay with being wrong, man, because you know what? I'm long anyway. But at the same time, they're screaming, we're going to go down because it's way too much reputational risk to say that the bottom is actually in. When the top was in and I was screaming the top was in, I was not like the most favorited person in the market. I was hated with all the cases in here saying the bottom is already in. But it's huge reputational risk to say it. So do your own research. Do you think the bubbles have popped? Or is the bottom in? Because there's only two things that can happen here. Either that's the bottom or the whole thing is collapsing and we're going into the Great Depression. Is the case strong that we are collapsing? You're not going to know the whole picture. You're just not. It's like doing a puzzle, but you only got 50 of 100 pieces. In the end, you're not going to get the final picture at the end. Is the whole thing crumbling down and we're going into the Great Depression right now, which everybody has thought we have every single time? Or we already completed the correction? The anatomy of a bubble structure of the stock market says that we are not behaving in line with what happens when collapses of bubbles happen, that they fall 40 to 50% in 60 to 70 days, call it 100, call it 150, whatever, 231 days at 19%. That's not the anatomy. And then at the exact same time, you have 6 different elements saying that the bottom of Bitcoin is also in as well. Make your best bet. Do what you think is right. I put my reputation on the line saying the top was in. It was S-talked by the masses. Now nobody wants to take the reputational risk for saying the bottom is in because they don't want to have that happen again. Either we're going into the Great Depression or the bottom is already in. Simple as that. And I just went and got some food to eat because that sounded a little aggressive and I might be a little bit hangry. But the grand point of it all, like I said at the beginning of the video, is that get this picture right and everything should be okay. Get this thing wrong, probably going to get crypto wrong too. So the question becomes, is the stock market behaving like a collapse and a bubble popping? And my thought is no, and that this bubble is going to get bigger. I'll be cautious at retraces, but my best guess is still that we're going to get through the retraces, even though caution at the dang retraces, then caution at the 4.236 extension. But I think there's a really good case. It's going to go beyond that. It's going to get euphoric. It's going to become a new paradigm. It's going to be that we can never go down and that the true top of the stock market or the true top of the Dow Jones Industrial Average is somewhere between 60,000 and 84,000. Because in most typical bubbles, when you collapse 70% on your first initial large wave. And this is usually the collapse to level. In order to get there from here, that's about how far you would fall. And that we are merely halfway up this bubble before it gets excessively big and then the whole thing comes crumbling down. And that is the moment that will be terrifying for our future. And unfortunately, for most people watching this, that will be within our lifetimes. But I just don't think we're there yet. And for all the inverse Kramer people out there, look what you got this week. Kramer says, avoid all speculative investments like crypto as the Fed stays hawkish, which is right in line with the narrative of what retail believes. But remember, it's two teams. It's retail and it's institutions. And mainstream media's design is to wrong foot retail. Every time. Upside, downside. When institutions are wanting to buy, feed a mainstream media message of negativity. When they're wanting to sell, feed a mainstream media message of optimism. So to each their own. Is the anatomy of the Dow Jones a bubble popping structure, that of a mid-cycle ABC correction for a massive bubble that's getting printed out here? I don't know if it's going to be a massive bubble. I don't know if it's going to go just a little bit higher to go on and hit a 4.236 extension, and if this is the first initial profit take. But what I can say from looking at the structure that's happening in here, that's nothing like what of an initial pop actually looks like. It's not what historical pops for the Dow Jones look like. It's not what historical pops for the NASDAQ look like. And it's not historical pops of Bitcoin, ARK, gold. It's not what a historical pop looks like. You're usually going to get something aggressive coming out of here. And there hasn't been anything aggressive. And it's still holding its moving averages. And it's holding the previous high set from February of 2020. You take out that moving average, you take out that low, I'll change my tune in a heartbeat and say I'm wrong. But at 231 days, I could say, based on all the bubble pops we just looked at, it's not behaving like any of those bubble pops. And it still has similar structure of that in which the parabola does continue. And if that's true, if the 70% crash is back into this level, then there's still a big euphoria phase left in this market. And I get it. Very difficult to see something like that right now with the narrative that's going on out there. But in my experiences of being in this market, the bottoms are never optimistic. They are always pessimistic, and the tops are always optimistic. When it's obvious that, oh yeah, everything's good, it's obvious we should be buying, that is never at the bottom. That is always at the top. So that's going to be it. This was kind of a weird video. I went I don't know, I got hungry halfway through it. I got hangry. And then I probably said the word anatomy 30 times when I was going back and listening to this thing through the editing. I was like, what am I doing? But either way, I wanted to point it out in there that the structure of 19% in 231 days is unlike any pops. Pops are typically 40 to 50%, ranging from days to weeks. We're going on 8 months at this point with 19%. That's not what it's like when a bubble actually pops. So we take out the 200-week moving average. I'll change my tune in a heartbeat, but I just don't see it. And for that, I'm bullish on crypto. So food for thought for everybody. I know right now on Twitter, it is still the case. Bearish tweets get the most engagement. And being experienced in here long enough to know that the stock market is only down 19% from its all-time high, and that you get that much engagement, and that the Twitter spaces are full of bears. You're not going to find a Twitter space on Twitter right now that is full of a bunch of bulls just talking about bullish cases right now. It is nothing but bears. It's interesting. So, all right, here I am. I'm rambling again. What am I doing? All right, it's the end of the week, guys. It's going to be a weekend. I'm going to be off this weekend. I will be traveling this weekend. We're just visiting family and staying with them for the weekend. Otherwise, I'll be back here on Monday, which is going to be Labor Day here in the United States, but I'll still be here. I want to wish you all a good weekend. I want to thank you so much for watching. I hope in all of whatever this video was, it provided some type of wheels turning in your brain thinking, if we've popped, why are we only down 19% in the Dow in 8 months? It's not what we usually do, but we'll see how things go in the coming weeks. All right, I'm going to go ahead and wrap this thing up. I want to thank you so much for watching. If you could, please like this video and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.